Getting and maintaining good credit is an important part of your financial well-being.
Credit is a fundamental part of life. Your credit is important because it can affect everything from going to college, buying a car, having insurance, and renting or buying a home.
Credit is a financial arrangement between a lender, such as a bank or credit card company, and a borrower, such as an individual or a business. When an individual borrows money or gains access to goods or services, they also must have the understanding that they will pay for those items later, often with interest. When you borrow money or use credit, you are essentially taking out a loan. The lender agrees to give you a certain amount of money, and you agree to repay that amount over time, usually with interest. The lender uses your credit history and other factors, such as your income and employment status, to determine whether or not to approve your application. Credit history refers to a record of an individual's borrowing and repayment activities over time. It is a detailed account of how a person has managed their credit accounts, such as loans, credit cards, mortgages, and other lines of credit. Credit history provides information about an individual's financial behavior, including their payment patterns, outstanding debts, and the length of their credit relationships. Credit history is maintained by credit bureaus or credit reporting agencies, which collect data from various financial institutions, lenders, and creditors. They compile this information into credit reports, which serve as a summary of an individual's credit history. The credit report includes details such as the types of credit accounts held, the amount owed, the payment history, the length of credit history, and any public records related to financial activities, such as bankruptcies or tax liens. It also includes inquiries made by lenders or creditors when an individual applies for credit.
Today we're defining credit. Credit has three definitions when it comes to personal finance. It can refer to lending, it can refer to a person's or a company's financial reputation, or in the accounting sense, credit can refer to funds received. Let's go over each definition in more detail. The first definition for credit is in the context of lending.
Yes. Lending and borrowing is one of the most important elements of any financial system. Most people, at some point in their life, are exposed to borrowing, usually by taking a student loan, a car loan, or a mortgage.
This is where credit allows customers to borrow money in order to purchase goods or services now and pay later.
Traditionally, lending and borrowing is facilitated by a financial institution, such as a bank or a peer-to-peer lender.
In exchange for the money supplied on credit, a lender can charge interest and fees. The second definition is financial reputation. It's another way of referring to a person's credit score.
Once you establish a line of credit by borrowing and repaying money in some fashion, you'll have a credit history.
Having a good credit score can change your life, and conversely, a bad one can ruin it.
Equifax, Experian, and TransUnion are the three major credit reporting agencies.
Your score can vary minorly or even by 10s to 20 to 30 points between these three credit bureaus simply due to how they calculate the scores and what's reported to them.
Your credit score is more than a number. Your payment history is the main factor in your credit score.
In general, the biggest factors that will affect your credit scores are the number of payments you have in your name, the type of accounts you have, like auto loans or credit cards, how much credit you're using versus how much credit you have, how long you've had your credit for, and your payment history on all credit lines. The best way to think of credit scores are that they're numerical measures of how good of an idea it is to loan you money.
Your credit history is a record of all your repayments and debts. A credit report is a physical record of all those transactions from sources such as banks, credit card companies, agencies, and government entities. Everything that you have borrowed money for, including student loans, store credit cards, and car loans, may be on your credit report.
So in this sense, credit is measured based on the information in your credit report. The third and much less common is for accounting. Credit in the context of accounting refers to the funds that you receive. A paycheck deposit to your bank account would be an example of a credit on your household's balance sheet. The opposite of credit is a debt, which refers to funds that you withdraw or pay with. At the end of the day, though, someone asks how good your credit is, they're probably referring to the second definition and want to know what category your credit falls under.